Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com.
You're listening to Real Estate Radio Washington, D.C. Metro with local expert Ryan Sloper. Now, here's Ryan.
Welcome back, Washington, D.C. Metro, to Ryan Sloper's Real Estate Radio, and I'm joined today by Louis Cammarosano, the general manager of HomeGain. Quick reminder, Real Estate Radio is designed to build the Washington, D.C. Metro's market one house at a time by giving you guys good free advice. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030. We're going to jump into what happened in the markets last week. This week's Word on Wealth segment. This segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. Go to HomeGain.com today to see what I'm talking about. All you have to do is type in your home address, and you'll get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free. So, guys, when you get a chance, check that out today. It's HomeGain.com. So, this week, there's not really any economic releases that are due out today, but there's a lot of key data throughout the rest of the week. Inflation reads, retail sales, reports on factory usage and output, housing starts and permits, and the key Philly Fed Business Index. Now, these economic releases recently have been secondary, really, to the constant and confusing news that seems been coming out of Europe every day. And really, the main thing that's been dictating mortgage interest rates has been Europe and what's going on there, and are they going to be bailed out, or how long can they continue to kick the can down the road before this eventually comes to a boiling point? I really think that it seems as though mortgage rates have been holding in a steady pattern over the last 2 weeks, not going up more than an eighth, not going down by more than an eighth. And I really think that trend is really gonna hold. I really don't see, unless there's something major like a catastrophe in Europe. And even if that happens, I think interest rates will get better and not worse. Just because people tend to they panic and they pull their money out of stocks and they're going to throw it back into either the 10-year bond or mortgage-backed securities, which will push rates down even further. So I think for the $1 million question that I've been getting a lot is where do you see interest rates going through the end of this year, through the holiday season? And over a long period of time, technically, you'll see a lot of people actually try to get their stock portfolios in line before the end of the year. So they'll try to make it a little bit more safe, or take their gains and go ahead and secure those before the end of the year. So I really think that interest rates are going to hold steady around the ranges that they're in now through the end of this year, without something crazy out of the ordinary happening. I really think that they'll hold around this 4% range, depending upon your credit qualifications and what type of loan you're looking to take out. But on the 30-year fix, they've been averaging around 4.09%. That's according to bank rate, but somewhere around that range. I believe that's going to hold true through the end of this year. But that's just my opinion. What do you think, Louis?
I think you're right. And if you look at what happened in Italy, Italy's had that problem, the debt problem, just like the United States has had the debt problem, the debt to GDP, and not doing anything to fix it. And all of a sudden, investors realize, wait a minute, I can't lend money to Italy unless they pay me 7%.
Right.
Nothing has changed. All of a sudden, the market focused on it. So right now, the market's focused on Europe. They're not focused on the United States. And since they're focused on Europe in a very myopic way, they think it's safe to put money in the U.S., and therefore interest rates stay down. But I was listening to a radio interview by Nial Ferguson. I don't know if you're familiar with him. He's an economic historian. He did a PBS series called The Ascent of Money, and he tracks how basically he's focused on hyperinflation. And he was on a radio interview with Peter Schiff, and he was talking about how markets are myopic. They focus on one thing at a time, even though the other issues, the United States has its own issues, and interest rates should be drastically higher.
Yep.
But people aren't focusing on that. But then something happens. He says you're okay until you're not okay. And that's kind of how we saw in 2008 the financial crisis. All the problems with the financial crisis were there, with the mortgage rates. With the mortgage-backed securities ready to default. It was there if people were paying attention, but no one was, and no one wanted to focus on it. So the stock market kept going up, and everything was fine until people realize, wait a minute, we have a huge problem here. So you're right. Interest rates right now, because they're being kept artificially low, not only by the Fed but also by what's going on in Europe, will stay low until people realize, wait a minute. They'll focus on the fact that the U.S. owes $14 trillion, not including the unfunded liabilities, and you'd have to be foolish to lend money to the United States at 2 or 3%.
Yes.
But that'll happen, but it's not going to happen between now and the end of the year.
No.
And that's why you're smart to lock down one of these long-term interest rates, if you can, and purchase your home, because at some point that's not going to be available.
Yeah, you're absolutely right.
You can't say when, but the fundamentals are there. It's not a matter of speculating. It's only speculating as to when people will realize it's not a safe bet to lend money to a sovereign entity that owes more money than all the other sovereign entities that are having troubles right now.
Yeah. 877-245-2030, 877-245-2030. That's the number. Like I said, to take advantage of the low rates today, reach out to me. I'd be glad to look at your individual situation if you're in the process of buying a home or even potentially looking to refinance. Lewis, you bring up a great point because, these are things that are going on right now. But you and I often talk about, what the long-term implications of everything that's going on. And we both believe that everything that's going on with the government, manipulation and intervention is just more and more inflationary down the road. We don't know exactly when that's going to take place, but we've already seen the rising costs of gas and food, and the reduction in sizes of boxes, the boxing of food. And I mean, they're just trying to get people's minds off what's actually going on. But I think that long term, to protect you and your family, the best thing that you can do, if you're able to, if you qualify, is to lock in these long-term interest rates and buy a home. If you're able to. If you are able to.
As long as the home is a decent price, you can even absorb some downside on the home price if your cost of shelter remains low because you're paying a low-interest mortgage every month 2, 3, 4 years from now.
Lewis, interesting fact. In the last 6 months, mortgage interest costs have dropped 21%. 21%. Now, for those of you out there that are trying to figure out, what exactly that means you're paying 21% less in interest charges over the life of a loan than you were 6 months ago.
And what are rents doing during the same time period? I guarantee you they're not down.
They're rising by probably 10 to 15%.
That's right. So,
that's a tremendous. So if you take that into consideration, the cost would be even more. Because if you opt out of buying and you have to go to rent, it's going to cost you even more.
And that interest rates have to go higher because the United States will never be able to. They can pay off their debt. Well, they can liquidate. We can liquidate our debt by defaulting, which I don't think is going to happen. And you heard Greenspan on TV the other day saying, "Not a problem. We can always pay because we'll just print up the money." Well, that in and of itself is inflationary. And once investors realize that they're being paid back in inflated dollars, they're going to ask for higher rates. And when they do, mortgage rates are going to go up.
Right. And everybody keeps talking about how we need to have private mortgage lenders enter the market. Guess what? They're not entering the market until rates are at 6%. Yeah, until they get closer to 6%. At 4%, nobody wants to lend their money out for that. They can go anywhere and get a better return than 4%.
But then you also get the foolish Keynesian argument that, interest rates are low, so the U.S. should be borrowing even more money.
Yeah. Yep. Well, the problem is for most people, the borrowing of the money is not the issue. It's qualifying to borrow the money. That's the problem.
It's also figuring out how in anyone's name can you pay it back.
Yeah.
If we already owe $14 trillion, just because you can borrow more when you can't pay back the 14 doesn't mean that you should.
And see, that's the difference between the average American and the government is that they can just pull money out of the air. The average American can't.
But when you pull money out of the air, you're debasing the currency and you're causing inflation.
Yeah, and that's been going on for some time, and I mean it's going to continue to go on.
It's been going on since we got out of Bretton Woods and Nixon closed the gold window in 1971.
Yep, and then it's just
the dollar is not backed by anything,
and it's only a matter of time before the dollar at some point will become extinct. We've discussed that for many of months now. Is that there's never been a fiat currency that has ever not become extinct at some point. We are headed down that road.
And you want to be paying back your mortgage in dollars that aren't worth very much.
Yeah. Just to give you guys a real-life example of two 30-year fixed-rate mortgages for $300,000, one from April of 2011 and one from today. In April 2011, a $300,000 mortgage would require $275,000 in interest paid over time, and then that was the interest rates as of that time. As of November 2011, that same $300,000 mortgage now requires $217,000 in interest paid over time. In other words, that's a difference of roughly you're chopping off $57,000 off your long-term interest costs. Now, I don't know how else to break that down to people, but what could you do with the $57,000 that you're saving? Maybe for education, maybe for for setting it aside for a rainy day fund that you don't have now. I mean, there's so many different things that you could do with that money, and I really think that by people sitting on the sidelines thinking, oh, well, 4% is not good enough, it's going to get to 3.5%, I really think you're kicking yourself in the butt to think that, because ultimately there's more chance of interest rates going up than there are coming down.
It's not just more chance. The amount at which they can go up is much
greater,
more than they can go down.
Yeah, absolutely. But
they're not going to go to 1 or 2%.
But, Louis, I'm talking about the average rate shopper out there. They get hung up on 1/8%. An eighth.
Well,
like the difference between 3.875 and 4%.
Well, they're also hearing from the Federal Reserve that we somehow, meaning the Fed, are going to keep rates low. So they figure, well, let me just see how this plays out. So they have no incentive. They're actually trusting what the Fed says rather than the macroeconomic situation, which says interest rates have to go higher.
Yeah, and
they're basically trusting that the Fed can keep them down through the manipulation.
Yeah, every week the Fed, they keep posting these releases. Fed Operation Twist passed $25 billion in mortgage-backed securities. Just this past week, Fed Bank of New York purchased $5.5 billion in mortgage-backed securities guaranteed by the government for the week ending November 9th. Since October 3rd, it has acquired $25.5 billion in Fannie Mae, Freddie Mac, and Ginnie Mae securities. Basically, this is going to keep long-term mortgage interest rates where they are.
And here's another thing for our listeners in the next couple of weeks. If this so-called super committee doesn't reach any kind of meaningful deficit reduction, you might get another downgrade from Moody's or S&P, and rates might rise.
Yes, and that's there's a high likelihood that could happen.
So that's the one caveat about between now and the end of the year, nothing happening.
Yeah, that's the one event that could throw things off.
Yes.
When we come back, we're going to jump into how you can refinance your mortgage without having to start over on another 30-year period when we come back.